ASC 205 Financial Statement Presentation, Section 405, Discontinued Operations and Liquidation Basis. Welcome back, focused learners, to the explainer. So, in our previous module, we tackled the whole going concern assessment process, right? We looked at trigger conditions and disclosures for when there's real doubt about a company's survival. Well, today, we're significantly raising the stakes. We are moving from mere doubt to actual action. We're going to explore exactly what happens to the financial statements when a company officially pulls the plug, whether that means selling off a massive chunk of the business or just shutting down the entire entity altogether.
Here's our roadmap for today's journey. First, the two-part discontinued test. Second, updating the income statement. Third, the held-for-sale balance sheet. Fourth, triggering the liquidation basis. And finally, number 5, accounting under liquidation.
To really set the stage here, let's bridge where we just were with where we're heading today. That going concern assessment, that was all about evaluating doubt. It was essentially asking, hey, can we actually survive the next year? But discontinued operations and liquidation are entirely different beasts. This is about executing a concrete action. It's about a company definitively saying, we are officially stopping this specific part of the business, or even, we are stopping the business entirely. And when those actions happen, the rules for how we present the financial statements change dramatically. We have to tell the users exactly what is going away and what is staying.
Which brings us to our first crossroad, the two-part discontinued test.
So, when a company sells or even just plans to sell a major part of its business, you can't just jumble those exit numbers in with your ongoing operations. It just doesn't make sense. That exit might need to be presented entirely separately on the income statement as a discontinued operation. But you don't just get to use this presentation freely. There is a very rigid, strict gate you've got to pass through first. Both of these distinct steps, the component test and the strategic shift test, must be satisfied. If you fail even one of them, no special discontinued operations treatment for you. Let's break down step 1, the component test. The item you're disposing of absolutely has to be a component of the entity. Now, what does that actually mean in practice? It means it has operations and cash flows that can be clearly distinguished from the rest of the entity. We're talking operationally and for financial reporting purposes. So things like a legally separate subsidiary or a whole business unit, those qualify. But what if you're just ditching a single product line that shares a warehouse with your other stuff, or selling off a few old delivery trucks? Yeah, that doesn't cut it. You literally have to be able to cleanly slice it away from the core business.
Okay, so let's say you pass that component test. Now you face step 2, the strategic shift test. The disposal has to represent a strategic shift that will have a major effect on the entity's operations and financial results. And what qualifies as a major effect? Think massive, fundamental moves. We're talking exiting an entire major product category, or pulling completely out of the European market, selling off a non-core warehouse, or maybe closing down one underperforming store location. Nope, that does not qualify. It has to fundamentally change the actual shape of the company.
And I want to issue a serious caution here, right from the source material. The strategic shift test is, for sure, the more difficult of the two to apply in practice. Small disposals, even if they're legally separate subsidiaries that perfectly pass that first component test, they often fail this second bar. You always have to ask yourself, does this exit actually change the nature or shape of the business? And because this is highly subjective territory, you must document your judgment clearly and thoroughly.
All right, moving right along to Section 2, updating the income statement.
Once a component officially qualifies as a discontinued operation, your income statement literally splits right in two. The top section becomes income from continuing operations. This captures all the revenues, expenses, gains, and losses from the parts of the business you are keeping. This is crucial because it tells the user what tomorrow's core business is actually going to look like. Then the bottom section becomes discontinued operations. This houses everything from the exiting component, the revenues, expenses, and the actual gain or loss on the disposal itself. And listen, here's a critical rule you can't forget. Prior period income statements must also be reclassified to show this exact same split. It's mandatory. Users absolutely need to be able to compare apples to apples across years.
And speaking of mandatory, here is a strictly non-negotiable rule. Discontinued operations must be presented as a single net of tax line. You absolutely cannot bury the detailed line-by-line income statement of the discontinued component up inside your continuing operations. The segregation is mandatory. Presenting it as a single net of tax line makes sure users aren't confused for a second about what's staying and what's going.
Let's jump to Section 3, the held-for-sale balance sheet.
So once management officially commits to a plan to sell a component and that sale is realistically expected to close within 12 months, it gets classified as held for sale. At this exact moment, your balance sheet presentation has to shift. The assets of the disposal group are completely sequestered and shown as a separate current asset line. Likewise, the liabilities of that disposal group pulled out and shown as a separate current liability line.
Now, treat what I'm about to say like a flashing neon hazard sign. The assets and liabilities of the disposal group must not be netted together into a single line. No way. They must be shown separately at gross presentation, even if the net amount between them is tiny. Netting these lines is such a common trap, and I guarantee you, auditors will absolutely flag this the second they catch it.
All right, so far, we've just been talking about carving out a piece of the business, right? But let's raise the stakes to the ultimate level. What happens when it's not just a division or a subsidiary? What happens when the entire entity is shutting down?
That brings us to Section 4, triggering the liquidation basis. The liquidation basis of accounting is rare, but when it does apply, it triggers a complete and total transformation of your financial statement framework. It only applies when liquidation is imminent. Now, in this context, imminent isn't just a casual vibe or a really bad quarter. Imminent is a highly objective bar. It means one of two very specific things has happened. First, a plan of liquidation has been formally approved by those with the authority to do so, like the board of directors, and the chance of that plan being reversed is remote. Or, second, liquidation is being forced upon you by external forces. Think involuntary bankruptcy proceedings or a regulatory dissolution order.
Now, it's equally important that we're crystal clear on what does not trigger the liquidation basis. Management just considering liquidation in a meeting doesn't trigger it. A plan that's still pending approval or faces a bunch of uncertainty doesn't trigger it. General financial difficulty? No. And most importantly, and this is absolutely crucial, substantial going concern doubt does not trigger it. Remember our bridge from the start of this explainer? Going concern doubt and liquidation basis are two totally separate determinations. A company can have substantial going concern doubt, heavily disclosed in their notes, yet still be operating under the standard going concern framework. The liquidation basis requires that formal, approved, irreversible reality.
Let's move to our final section, Section 5, accounting under liquidation.
Once triggered, the shift in the numbers is dramatic across the board. Under a normal going concern basis, you know the drill. Assets are measured at historical cost or fair value. But under liquidation, they shift entirely to net realizable value, meaning the expected selling price minus the costs to sell. Under going concern, you only record normal liabilities. Under liquidation, you are required to accrue an additional liability for all the estimated costs of liquidation, lawyers, wind-down costs, severance payouts. And what about revenue? Well, under going concern, we use ongoing accrual accounting. Under liquidation, traditional ongoing revenue is completely gone. It's not applicable anymore. The entire focus shifts solely to net realizable values.
Because the focus of the business shifts so entirely, even the names and formats of the financial statements themselves change. You no longer issue a standard balance sheet and income statement. That's out the window. Instead, you present a statement of net assets in liquidation and a statement of changes in net assets. That ongoing accrual revenue framework essentially ceases to exist.
Now, because adopting the liquidation basis is such a fundamental and frankly irreversible step, there is a strict escalation protocol you have to follow if you see signs of imminent liquidation. First, do not change the accounting basis without written authorization. Second, escalate to your manager immediately. Third, meticulously document all the conditions you observed and exactly when you identified them. And finally, stop issuing financial statements under the going concern framework if liquidation is truly imminent, because doing so would literally be factually incorrect. Listen to me on this one. This is never, ever just a judgment call at the staff level. It requires a formal, written assessment and manager's sign-off, period.
Which brings us to our final thought for today. Are you ready to act as the gatekeeper for these critical accounting crossroads? Whether you're enforcing that rigid two-part test for a discontinued operation, stopping someone from improperly netting held-for-sale assets, or recognizing the incredibly high bar of imminent liquidation, your precision is what ensures users actually see the true reality of the business. Take these frameworks to heart, because in our next lesson, we are getting even more hands-on. We'll be diving straight into practical application, covering preparation, audit controls, and even the tricky nuances of US GAAP versus vast differences. Until then, keep your standards high, keep your documentation clear, and thanks so much for joining me on this explainer.